I've tested countless day trading indicators throughout my career, and truthfully, most of them are completely useless. In this video, I'm going to save you a ton of time by teaching you the three indispensable indicators that have been the backbone of my trading success over the last 2 decades. You're going to learn how to spot high probability reversal points, just like this, using one of my favorite indicators seen right here. I'm also going to teach you how to confirm breakout trades, like this setup here, with an indicator that every day trader should be using. We will cap it off with the most powerful indicator I use in my strategies, one that lets you predict critical support and resistance levels for high probability reversal setups. You literally can build an entire career around this indicator alone. All three indicators we will be covering can be used to day trade or swing trade in any market. First on the list, we have cumulative volume delta. CVD has played a critical role in my career as a scalper. Let's break down the indicator and then take a look at some trade examples. Volume delta is calculated by taking the difference of the volume that traded at the offer price and the volume that traded at the bid price. Cumulative volume delta simply takes the delta values for every interval and displays them visually on a graph as seen here. We can use a bid-ask footprint to illustrate how delta is calculated. The bid-ask footprint displays the amount of volume that traded on the bid as well as the volume that traded on the offer for every single price increment. Once we have bid and offer volume, we can now calculate delta. For example, at the 28.74 handle seen right here, 113 contracts traded on the bid price at 28.74 and 125 contracts traded on the offer price. Again, offer volume less bid volume equals delta. In this example, we would take the offer volume of 125 less the bid volume of 113, resulting in a delta value of 12. So what does the delta value tell us? If delta is greater than 0, buyers are the aggressor, as more contracts traded on the offer than the corresponding bid. If delta is less than 0, sellers are the aggressor, as more contracts traded on the bid than the corresponding offer. Delta and price will typically move in the same direction, which makes sense, right? If buyers are aggressively taking the offer, then the prices should go up. And if sellers are aggressively hitting the bid, prices should go down. So what's occurring in this example where we have divergence between price and delta? Notice price sold off and broke the previous swing low, but delta wasn't able to. When this occurs, we say the buyers have been exhausted, as they are less interested in selling at the lower prices, illustrated by delta not breaking the swing low. When sellers are exhausted, there's a high probability that price will reverse, which is exactly what happens here. Here's another example of divergence, but this time we have delta breaking the swing low and price failing to. When this occurs, we call it absorption. The aggressive selling pressure, illustrated by declining delta, is being absorbed by the buyers. Ultimately, what's really happening is buyers are stepping in on the bid with limit orders more aggressively than sellers are hitting the bid with market orders. As the buyers absorb the selling pressure, price reverses and the uptrend continues. Using cumulative volume delta to scalp divergences can be extremely lucrative when you're applying the proper context. It's an indicator that does require a lot of screen time to master, as well as a strong understanding of the individual characteristics of the securities that you're trading. If you're a new trader or simply not yet profitable, the third indicator we will cover is perfect for building context around delta setups. But first, this next indicator provides critical insight when looking to confirm breakouts or when looking to play a reversal in a stronger trend. I'm still shocked at the number of students I have worked with over the years who had never used this indicator prior to working with me. There's a reason why it's been a standard indicator on every piece of charting software for the past 30 years. It provides a critical edge to day traders. I'm talking about a simple volume indicator. The easiest way to understand volume and its relationship with price is to think about what's happening in terms of market participation when volume is increasing versus decreasing. Volume increases as more market participants, buyers and sellers, enter the market, and volume decreases as market participants leave the market. For a security to trend, the rising prices in an uptrend or falling prices in a downtrend must attract new market participants. Failure to do so will lead to the trend stalling and price action either going sideways or reversing. In this example, price is trending upwards and takes out the $10 handle, which we can see is heavy resistance notated by the number of sellers versus buyers. Once price broke through the $10 handle, new participants failed to enter the market as represented by the declining or flat volume. Simply put, not enough new aggressive buyers entered the market above the $10 handle to take the price higher. As price stalls, buyers who bought the surplus of offers at $10 will begin to liquidate their positions, driving prices down, potentially ending the trend. In this next example, when price breaks through the $10 handle, we see new participants enter the market, confirmed by the increase in volume, and the trend continues. This process repeats over and over in every single trend until price reaches a level that fails to attract new market participants. When evaluating a potential breakout, you want to confirm that you're seeing an increase in volume. Let's take a look at some examples. The blue line you see here on my volume indicator is simply a 20-minute simple moving average. It allows me to quickly glance at volume and evaluate market participation. In this example, price breaks out to the upside and begins to consolidate into a range. We have a breakout to the downside, but notice the volume is light. Price fails to sell off and drifts back up into the range. You could have used volume to validate this setup, in which case you would have passed on this trade due to the low market participation on the breakout, illustrated by the below average volume. Price consolidates a little longer and then breaks out to the top side of the range. But what's different this time? This time, the breakout is accompanied by increasing volume, confirming you would have taken this entry. This is such a simple way to build context, especially for new traders. Use it, it works. We can also use volume to find capitulation. Capitulation is a dramatic surge of buying pressure in a rising market or selling pressure in a declining market. As the move accelerates, it will reach a point where traders are unwilling to suffer further losses, leading to a surge in price as traders make a mass surrender. Capitulation often marks the end of a trend, as those who didn't exit during a panic are unlikely to do so soon after. It's what I call a shakeout of the weak hands, traders lacking conviction, replacing them with more risk tolerant holders who may not have suffered losses in the recent moves, resulting in a price reversal. Even if you are a trader who doesn't fade trends, you can use capitulation in your trade management as an early warning sign to begin exiting some of your position or to tighten your stop. Finally, we have my number one indicator, the volume footprint, also called volume imprint, number bars, or just simply volume profiles. They have been my ace in the hole for over the past 2 decades. Volume always has a story to tell. I personally believe it's the most important story that the market has to tell you. If you noticed, all three indicators in this video are derived from volume. If you're interested in trading order flow, really if you're just trying to become a profitable day trader, I would begin by learning volume profiles. Some good news, you've come to the right place to learn about them. I primarily use volume profiles to build context around my trades. You can think of context as a CEO of your trading business. It looks out above the trees and says, we're going that way. Let's cover the main components that make up a volume profile and then look at some trade setups. First, we have high volume nodes, which are areas of high volume relative to surrounding price action. Next, we have low volume nodes, which, as the name implies, are areas of low volume relative to surrounding price action. Third, we have the point of control, which is simply the price level where the most volume traded for the user defined interval. High volume nodes act like gravity. They tend to track price and try to hold it there. Conversely, low volume nodes are areas with very little gravity. The market often rips right through these areas, not staying long because of the low liquidity. For those of you who are familiar with market profiles, you can look at low volume nodes similar to single prints. Prior high volume nodes will act as support or resistance when price is retracing back into them. You can look to play reversals at high volume nodes in the direction of a trend, as seen in this example. Let's take a look at some real setups. In this example, price is breaking out to the upside and closes the hour out just above the high volume node. You can project prior high volume nodes forward on your chart to find high probability support and resistance levels, providing a logical place to look for an entry. In this example, price retraces back to the HVN but is rejected and continues its upward trend. In this next example, we have an extremely bearish trend. Once again, we can project the high volume node forward to find a logical place for an entry. In this example, price retraces back into the high volume node, and once again, the sellers are the aggressor. Price is rejected and continues lower. Now let's take a look at an example of how you can use low volume nodes, but this time we're going to combine all the indicators that you've learned today. There's three critical pieces of information this chart is telling us. Take a few seconds to see if you can determine what they are from what you've learned so far. Number one, price broke the swing high, but delta failed to. What's occurring here? If you guessed exhaustion, you were right. Number two, we have a low volume node right below the current market. And number three, volume was light on the breakout to the upside. What do you think happens next? Price reverses and rips through the low volume node. Also notice how the breakout to the downside was validated by the increased volume. I promise you, the better you become at building context around your setups like we did in this example, the more success you will have as a day trader. If what we have covered so far seems to click for you and you want to go deeper, I highly recommend you do the following three things. Number one, check out my free day trading course, link in the description of this video. Number two, help my channel out, like this video. Number three, subscribe so you're notified when I release future training. I'll see you in the next video. Take care.